We're really pleased with our first half results. Group revenues, $23.5 million. That's 34% improvement on the prior year. And that's enabled us to deliver EBITDA growth of 69% with our adjusted EBITDA of $4.3 million. Just breaking that down a bit into the divisions. So our payment business continued to perform well. Revenues of $20.2 million were up 19% year on year. And that was driven by TPV growth of 47%. Take rates continued to come down, but certainly at a much sort of more gradual attenuation than we'd seen in previous years. So 0.9% take rate for the half. But phenomenal gross margin in the payments business, as we've seen in previous periods. So 95% gross margin in payments is fantastic. We did benefit in the first half from a renegotiated contract, which enabled us to book revenues above where we had issued guidance earlier in the month. So revenues overall were better than we'd previously stated. But the phenomenal gearing of this payments business continues. So 6.6 million EBITDA was generated by the payments business. And putting that in context, that's compared to 6.3 million of EBITDA that we delivered in the full year of 2018. So payments continuing to do well, albeit growth rates are lower as we expected as the comparables get tougher. On the identity side, a really strong first period. We owned the company for 7 or 8 months now. We generated revenue growth on a pro forma basis of 34%, with revenues coming in at 3.4 million for the half. And identity contributed more than 14% of group revenues in that period. And that really starts to address some of the revenue concentration that we'd mentioned before in previous updates. Gross margins on identity were better than we'd expected. I'm not sure that's a sustainable position as some of the deals get bigger in the second half, but certainly we're very pleased to report gross margins of 43% against our full-term target that was 40%. On the operating expenses front, we have continued to make the investments that we talked about in sales and marketing resource. Identity is all about growth and building supply and continuing to grow demand in that business. But actually, we've had to do more restructuring than we thought. And so the overall increase in OPEX is lower. So our net adjusted EBITDA loss for identity is $2.3 million. On the cash position, we continue to have good cash balances, albeit our cash numbers have come down since December. December is a bit of a peak because it's a seasonally big month for us. We generated underlying operating cash of 2.8 million, and that was consumed by movements in working capital in our settlement business. But also we had some working capital commitments as part of the terms of the Neal acquisition. So underlying, we're not concerned about cash. Cash balances will continue to be strong.
Well, we've seen continued growth within the payments business. TPV up by nearly half to $2.3 billion. Number of monthly active users also increased nearly half. I think it's 47% to 15.3 million monthly active users, which is really encouraging trends. Now, those don't directly translate into revenue, but we're seeing good level of growth driven by sort of many more deployments that we're doing. In fact, if anything, our backlog of deployments is in a better space than it's been for a long time. More than 200 actually things sitting on our pipeline. So we continue to roll out our big customers across our carrier base. One thing that I think that's significant is the announcement that we made earlier in the year, where we had an agreement with GrabPay, because that shows us not only working with carriers as a source of funds, but also working with other alternative payment methods, and in particular these mobile wallets in Asia, which we think can really help us sustain a higher share of checkout than we currently get with carrier billing, which, given that the reason that our customers come to us in carrier billing is really to acquire new users, it somehow limits the maximum share of wallet you can get to about 15%. We think we can get to 30, 40, maybe even 50% in the right market if we integrate these wallets in the right sort of way, further sustaining our growth into the future.
We're really pleased with the progress that we're making so far in identity. The number of billable transactions that are passed through our platform increased by 100% to 141 million. We've had success in bringing in sales and marketing talent to help us on this journey of building supply in line with the demand that we're seeing. We have had to make some organizational changes, more than we'd anticipated, but ultimately the business is in good shape in order to see us through for the rest of the year and beyond. We're very much on track with that mission. It's certainly not something that happens overnight. We have to go around systematically, carrier by carrier, and build new commercial connections. But certainly we're very excited with the demand that we're seeing out there, specifically actually for this new concept of a tokenized mobile identity, which is generating lots and lots of interest from clients around the world.
The constraint to our growth in payments is not really anything to do with competition. I mean, the constraint to our growth in payments is as much as anything the pace with which our merchants can integrate new connections to new places and the way that we can take that through. We've got pretty adequate capacity, so we've been building up our ability efficiently to be able to roll out new carriers over quite some time. But it's not necessarily always the case that all of our merchants are just in exactly the same space. So we've captured a lot of new customers, and those customers do obviously then return business to us as they connect to new carriers. And if anything, it's the pace of that connection which is one of the fundamental things in terms of drivers rather than competition. On the identity side of the business, obviously broadly a similar position. I mean, clearly there's any number of people out there offering identity services, but on a global basis, there is practically no one else who is able to offer high quality carrier connections to carrier data. So many of the people that you might see as being competitors are, in fact, great candidates to be partners with Boku, because we've got something unique that's very difficult for anyone else to procure. But once again, probably the biggest constraint is on the supply side, in the words of being able to get the appropriate deals with carriers in order to be able to offer their services on and to create mobile identity and data services.
So we're obviously pleased with the first half, and that leads us to maintain our guidance for the full year, which was $52 million of revenue and EBITDA growth of between 45 and 50%. Why do we feel confident? Well, we typically have, particularly in the payments business, a much stronger second half than we do the first half. So obviously games season kicks in around about September, typically with launches such as FIFA. We always have a strong December. People are typically at home playing games in their bedrooms during that month. And remember, last year, comparables-wise, we had a much stronger first half because games like Fortnite were delivered early into the market. And so that was slightly different to what we'd seen in previous years. So again, it is a stretching second half. We do have confidence that we can get there. Identity is continuously growing. So remember, we would, as we have owned this business for a bit longer, would expect more revenue to come through in the second half than we saw in the first half.
Well, on a longer term basis, it's one of those things. Was it Niels Bohr who said, you should never make predictions, especially about the future? And clearly, the further out you get, the more uncertain it is about how granular you can be. Sitting where we are sort of blown away by the level of demand, especially in the identity business, where we have strong demand for the type of mobile identity services that we can offer, which is clearly having a real need. Now, exactly how quickly those deals get closed, exactly how quickly they roll out, it's hard to say. I mean, what we've got is a very strong proposition, a platform which is practically unique, and lots of big companies, working to try to use our service. So the fundamentals for the long-term uptake are very great. Then when you try to sort of triangulate that into, it'll be X% in Y year, then clearly there's a baseline of growth that we've got out of our existing businesses, which is pretty predictable. But then there's obviously more to do that has to come from things we have to sell or to deploy. And obviously, the further out you get, the more uncertain that becomes. But we're fundamentally very clear that we've got a product and a capability which is in very, very high demand. And on the payments side, I mean, it's pretty much the same. The payments business is more predictable because we've got more of the large customers operating. As we start operating more in wallets, I think there's going to be some degree of unpredictability. We don't know exactly how much take-up we're going to get in different countries. But once again, fundamentally, we can see that in many, many Asian markets, it is the mobile wallets that are becoming the primary payment mechanism for people online. And to have the level of demand from our customers for mobile wallets, of which an example is GrabPay, makes me very confident about the long-term future of this business.